Hi, and welcome to Leavitt Brothers tutorial on head and shoulder tops. Head and shoulder tops are powerful and reliable reversal patterns that appear as large distribution periods after a significant uptrend. Their completion may signal a trend reversal. Three successive peaks characterize the pattern, with the middle one being the tallest and the two outside ones being shorter and approximately equal. The chart here illustrates a completed pattern, but let's go through the sequence of events that unfold as the pattern develops. The left shoulder and first half of the head are formed as a pullback within an uptrend, followed by continued buying pressure. This action is no different than what is expected from a stock in a typical uptrend, and at this point in time, there is no way for a trader to know that a head and shoulder top is forming. The stock then begins its usual pullback within an uptrend, but not only does the stock trade below the left shoulder, it falls to or close to the same level as the previous pullback. The head has now been formed. This is the first sign the buyers may be getting tired. The stock seems to be losing strength. A trend line, called the neckline, can be drawn between these two troughs. The stock then rallies again, but is unable to eclipse its previous high. This is a second sign the uptrend may be nearing an end. A sell-off from the shorter peak, the right shoulder, through the neckline would mark a successful reversal of the uptrend. There is a tendency for head and shoulder patterns to develop a high degree of symmetry. This is amazing considering all the news and events and things that can influence a stock's price on a day-to-day basis. Some traders demand symmetry and only consider a pattern valid if the two shoulders are equal in size and duration. However, although this is desired and the pattern may have a very satisfying balance, it is not necessary. A perfectly symmetrical head and shoulder pattern doesn't form often. There usually is some distortion or variation, such as the formation of a second right shoulder in the pattern. And since chart reading is an art, there will always remain a subjective human aspect to the analysis. The neckline should be flat or slightly upward sloping. Downward sloping necklines do occasionally occur, but their existence indicates negativeness is slowly working itself into the stock, and a large correction is probably not imminent. In this case, the trader ought to look elsewhere for trading opportunities. Breakdowns do not have the same volume or movement requirements as their bullish counterparts. In fact, when a stock breaks support with a massive volume surge, it often signals that a capitulation, and the stock rebounds shortly after. The best downside breaks occur on average volume, followed by the stock drifting lower for a few days on increasing volume. Psychologically, when the stock first breaks support, stockholders become concerned. Many of them show a loss and some sell. As the stock trades lower, concern becomes fear and the selling accelerates. Then fear becomes panic and the people sell regardless of price. This is why there typically is a delayed volume surge with breaks to the downside. The character and extent of the expected price movement upon breakage depends on several factors. Typically, it is equal to the distance from the neckline to the extreme point of the head, but this is just a guideline. Head and shoulder patterns are reversal patterns, so there must be a significant move to reverse. The duration of the entire pattern, or how long the stock trades above the neckline, also plays a role. There's an old adage on Wall Street that reads, "The bigger the top, the bigger the drop." The extent and speed of the drop will be related to the extreme imbalance between buyers and sellers. A lengthy pattern suggests many people bought the stock above the trend line, and it is these late-to-the-party buyers who will provide much of the selling pressure when the stock breaks support. Whether the stock bounces back to the neckline after breaking support often depends on the overall market. If the entire market is weak, there probably will be no bounce. If, on the other hand, the market is trending up at the same time a stock completes its pattern, a bounce is likely. Let's go through a couple of examples to highlight these points. Here's Cameron International. Solid rally led to a head and shoulder top as shown here. The stock broke support on average volume and after falling a few days, bounced, but got rejected by the neckline. This is pretty typical and is nothing to worry about. You can't expect a stock to completely fall apart as soon as it breaks down. Notice how volume surged well after the breakdown, and in fact it was the volume surges that signaled the end of the selling. The height of the pattern did a good job determining an area the stock may run out of downside energy. ESV, I should say. A head and shoulder top formed after a 75% rally. The price action was herky-jerky around the neckline. This isn't all that common. We don't always get smooth breaks of support. The pattern eventually continued down, but came up a little short of the target as suggested by the height of the pattern. Instead, price stopped near the January low. Let's go through a couple more quickly. We find it helpful to look at successful patterns to train our eyes. Rowan Companies, head and shoulder top that resolved down and didn't find support until the February low on the left side of the chart was tested. Digital Lightwave, not exactly a smooth pattern and not a very large one either, but the setup is still there. 3 successive peaks with the middle one being the biggest. The stock broke down on slightly above average volume and then collapsed on huge volume. The measured move from the height of the head along with the gap gave us a good area to take profits. Olin Corp. 6-month head and shoulder top that offered a couple downside points. Krispy Kreme. Not a smooth pattern but valid nonetheless. That wraps up this tutorial. Again, head and shoulder tops are reversal patterns that tend to have delayed volume surges like other downside breaks. The odds of success are more closely tied to the action of the overall market than the specifics regarding the details of the pattern.